Well, I'm very clear that the potential of silver is massive. With the gold silver ratio, we've seen it up 130, and now it's come down over 40% from that level. And we are definitely going to see it going down to the level where it was in 2011, which is 30. It went down to 30 in 2011. And of course, the long-term rate, gold-silver ratio, gold divided by silver, is the historical long-term rate is 15. So there's still a long way to go. So that means that silver is going to go up probably 3 times as fast as gold. But we always warn investors it's a very volatile investment, and therefore, silver will be absolutely spectacular. At the same time, if you want to sleep well at night, you should hold more physical gold than silver, but hold, a good bit of silver also, but because there you're going to see, this is the poor man's gold. A lot of people are going to buy silver. Now, there are a lot of talks about shortages of silver in the market, and there clearly are real shortages, although we just had a survey, well, a Metal Focus does a gold source and silver survey, and they do it for the World Gold Council in gold. But, they have, and everybody talks about a surplus in silver for 2020 of about 80 million ounces. Now, that is an inconsistent way of measuring the silver demand, because they have excluded the silver ETFs. And the silver ETF demand in 2020 was 250 million ounces. No, there was 330 million ounces. So 330 million, and they said there was a surplus, but if you take off the 330, you actually have a negative 250 million silver in 2020. And that means that there is actually, has always been, a shortage of silver. Now, even JP Morgan with their SLV ETF in silver, they said that we might not be able to now meet the demand for our SLV shares with physical silver backing, because there isn't enough silver around. So they've changed their prospectus even. So, it's clear that there are massive shortages in the silver market. And of course, because of the general shortages of physical silver, one day that market will blow up. And that's when gold, silver is now, there's a resistance at $30, and they're trying to hold it there, the bullion banks, below 30. We see every time it comes near there, boom, it goes down a few dollars. But I think that will fail. And once it goes above 30, there's going to be a quick move to $50 in my view. So silver is an exciting investment, but don't look at it as a Reddit group. Don't look at it as speculation, because that's not what it's all about. It's about wealth preservation. And silver is a very, very good investment, as I said, to hold in addition to your gold for all the risks that we have discussed, and because that debt will blow up one day. And when it does, of course, there will be no real price of precious metals at all. And of course, as we know, there's so much paper, gold and silver issued. So there won't be enough supply. So there will be no supply, basically. And when there is no supply and very high demand, what happens to price. There will be no price. So that's a market that, this is not sensational. This is real. It's going to happen. But again, we're worried about risk, not actually the sensational or speculative aspect of it. Just hold your silver and your gold and protect yourself. That's what it's all about. The other thing is that we're seeing now, just briefly, is the stock market. The stock market is nearing a top. They can last for another 3 months or whatever, because you're at the end of a cyclical, very long-term move here on stocks, on the economy. So therefore, I would not be surprised that sometime in the next few months, that stock market's on all, everything you look at, fundamentally and technically, it is extreme. And the move in the last 12 months has been totally exponential. I have not seen a move like that for the last 100 years, basically. Again, we always fall back on history, because, you just look at the history of the U.S. debt from, you can start 1913 when the Fed was created. It's been a one way, hasn't it? That's absolutely. It's. I think since the 1930s there has been an increase in U.S. debt every year, with a couple of years exception, and as I point out many times, the Clinton years. Or fake surpluses. The debt went up, although the surplus, they showed a surplus, but that wasn't real. So, the history tells us really where we're going. It's so easy. And now it's going up exponentially because, it's virtually not possible to print unlimited amounts of money. And especially if you look at the Austrian school of thinking that inflation is linked to money supply. Not to prices as such, but to increase in money supply. And therefore, you cannot print trillions of money without actually affecting inflation. And of course, then we have our old hobby horse, which is negative inflation or negative real yield. Actually has a real impact on precious metals prices. I believe that now we are going to be not similar to the 70s, but the big problem for the US Fed is that they can't really control the dollar. They can control to some extent short-term interest rates, and they have succeeded so far very well, above my expectations, I must say. But now that they are, the money printing has now gone to an extent that I don't think it'll be possible to control the dollar. They've never been able to. I mean, the last time there was a joint action between all the central banks in the world was a long, long time ago. So that's not happening anymore. And I think that, with that amount of those trillions that the US have now created and printed, not just the Fed, but also the general debt in the US, the ways it has been surged, that will start to impact on the dollar. It has already. We're down approaching 90 again in the dollar index, and the euro, which is a rubbish currency, looks like it's actually in a very strong uptrend against the dollar. So I see that at some point, and that could be imminent. We had a small correction up in the dollar index now, and it came down 3% immediately. So I could see the dollar index crashing by from 90 to 80 to 70 to 60, etc. And then you get you will automatically have massive pressure on interest rates.